Hey everybody and welcome back to another video. This is How to Invest. Spencer here. Let's hop straight into the video today. There's tons of blood in the streets, or maybe tomatoes if you live in Spain, who knows. But boy oh boy, the markets were down today. We look at the Nasdaq, boy, 2.5%. The Russell 2000, 2.6. Crude oil even going down today upon rumors that it could skyrocket upon reopening and more demand. People just charging more for more demand, and the S&P going down over 1%, and the Dow just eking out at in the red today for being green most of the day here. I know I checked the markets multiple times throughout the day. I was working, so it's kind of hard to check during the day, but as I checked at the end of the day, I was just like, oh my goodness, I'm so glad I didn't buy any stocks yet. So sometimes it's good to wait. Patience can be a virtue. But this video will kind of get into why the markets continue to fall and what you should be doing in these times. So most of my thoughts are around the Nasdaq and the Russell 2000 because they fell over 2.5% today, which were quite substantial moves. But my main theory, but my main idea that I wanted to get across that is what really moves markets most of the time is not retail investors or, just the average Joe Schmo going out and buying a couple stocks. It's always going to be Wall Street and the big hedge funds, big money sloshing it around. And what they suffer from a lot of the time is a phenomenon called groupthink, where if a bunch of people are together, that an idea is easier to, if it's kind of hard to explain, but look it up on your own. But the idea is that it's easier to screw up as a group rather than as an individual. If you say, oh, hey, I'm going to go sell out of 10% of my stocks just because I've made a bunch of money already, and I think that the prices are getting out of hand, that some people might think that's ridiculous, but if 10 people do it, 10 more people might do it, and it becomes kind of this snowball effect. So if one hedge fund starts selling out of stocks, and usually the leader in this is Goldman Sachs, they're usually pretty ahead of the curve. They were the first in the Archegos fund kind of disaster, where the family fund was over leveraged and had, I think, over 20% in Discovery Plus and Viacom and a couple other companies across a bunch of different big banks and hedge funds. But if one hedge fund starts selling or buying, vice versa, selling a ton, then it prompts more to sell, more hedge funds, more banks, more people to sell in the market, and causes more selling pressure. So there has been a good amount of hedge fund selling. I think it's been an all-time high for the past 5 years of hedge fund selling currently, and that is why we're seeing a lot of negative selling pressure in the market. And a lot of these are happening in the Nasdaq and the Russell 2000 because they have seen so much growth in the past year. If we look here, over the past year, it has grown. Well, if we over a little bit over a year, since the March lows, it's almost doubled since 7,000 here up to peak of about 14,000. So those are quite substantial gains, and in most of these stocks, they've tripled or quadrupled or even 10x because the Nasdaq is just an index of funds grouped together. So a lot of the biggest winners have grown much more substantially than that. But what should you be doing during this time? My point, what I want to make as the individual investor or the retail, is that the one thing that we have on our side is time. The reason that a lot of these banks and hedge funds sell out and sell because not only groupthink, like I said earlier, but also they have clients that they're taking their money in. A lot of these is not their own money, and the clients will call them up if they see stocks going down, or they see an individual stock that they're in, or maybe the market, and they'll say, why am I losing money? And of course, a common term is rich people hate losing money, and they hate losing it the most. So if they're rich enough to give someone else money to manage their money, they're obviously going to be pretty mad when they're not managing their money in a positive direction and it's going down. Because really all the super rich people want is just beating the markets and beating savings accounts. They don't really care about getting triple digit growth every year. They want 5, 10, maybe 15%, 20 at the most. Maybe if they think 20 would be too risky, because they have to have a good amount of risk management, which is smart when you're handling that vast amount of money. But as an individual investor, you have time on your hands. So you can watch a stock go down 15%, and you don't have to tell a client or tell anyone. You don't have to tell anyone if a stock goes down 50% and you own it. That's the best thing about the stock market. If you're losing, you don't have to tell anyone. If you're winning, you don't have to tell anyone. But it can even be beneficial if a stock goes down in the short term. It gives you more time to buy. One of my biggest regrets was not buying more in Playboy, just because it shot up so quickly. But that's not always the case. If a stock goes down when you first buy in it, it could be a buying opportunity if you understand the company and understand the fundamentals and believe that this will grow over time. So that was just kind of my reasoning on what advantages you have over the hedge funds. And time is definitely your biggest asset. Like I said, if stocks are going up and they're owning all these bad stocks, and these stocks are going up, the indices are going up 10% in like 2 weeks, and relative to the market, maybe a hedge fund only went up 2%. Their clients are going to be pissed. So they kind of have to kind of tail and follow the rest of the crowd and not really be leaders, really. They kind of have to hedge their bets, so to speak, in a lot of cases. So go out there, find out companies that you understand, can run numbers on, and can predict that they will grow over the time and be more valuable in the future, and you won't have a problem investing. It sounds very, very simple when you put it like that, but that is pretty much the basics. And if you do that, over a long period of time, it will be very hard to lose money, I'll say. I was going to say you can't lose money, but there's always anomalies somewhere. But if you made it this far, thank you for watching. Have a good day.